As we are speaking, with the market open and trading, Beyond Meat, ticker BYND, is currently at $1.315 per share, and it is down 1.87% on the day, or about 2.5 cents. Volume is already explosive, tracking over 14 million shares just in this first hour of trading. And the immediate expectation when you see a price like that is to just write it off. To see a stock at $1.31, a name that was once an IPO darling, and assume this is just the final sputtering end of a long, slow decline. The expectation is that this is a ghost, a forgotten company bleeding out. But the reality is that this price, this movement, isn't a slow bleed. It's an acute, fresh wound. This stock is reacting right now to the earnings report that dropped just last night, and more importantly, the catastrophic guidance that came with it. The story isn't that this stock is near zero. The story is why it's here, and what the company just told the market about its future. What we're seeing today is the market processing a $112.3 million quarterly operating loss, a figure that is almost impossible to comprehend, driven by a massive $77.4 million non-cash impairment charge. That's the company itself telling you its assets, its factories, its equipment aren't worth what they thought they were. This isn't a slow fade. It's a financial crisis happening in real time. It's almost impossible to overstate the disconnect between the market narrative and the operational reality for Beyond Meat. Everyone remembers the common ground, the story that captivated investors and had platforms like the Robinhood app buzzing. This was the company that was going to change the food industry. Its 2019 IPO was one of the most successful in years, a cultural event. The stock soared from its $25 IPO price to over $230 a share. The belief was that plant-based meat was not a niche, but the future, and Beyond Meat was its leader. Investors from large institutions using sophisticated Fidelity brokerage accounts to new traders learning how to invest online all wanted a piece of this growth. The expectation was set: exponential growth, major restaurant partnerships, and eventual price parity with traditional meat. It seemed like a one-way bet on a sustainable future. Even today, you'll see people on forums and using their SoFi Invest app wondering if this, down 99% from its high, is the ultimate buy-the-dip opportunity. They see a price this low and think the risk is gone. But that's where the narrative collides with a brutal reality. The challenge to that common ground isn't just that growth stalled, it's that the entire foundation of the company's financial health is cracking. Last night's report for the third quarter of 2025 was the final nail in that coffin. Yes, revenue came in at $70.2 million, a 13.3% decrease year over year, which just barely beat an already lowered consensus. But the headline was the guidance. Management told the market to expect Q4 revenues between $60 and $65 million. The analyst consensus was $70.1 million. That's not a miss. That's a warning of a collapse. They are guiding for an accelerating decline in sales heading into the holiday quarter. All of this led to a net loss of $110.7 million, or $1.44 per share. The street was expecting a loss of around 43 to 47 cents. The company lost nearly 3 times what analysts thought was possible, largely because of that $77 million impairment. They are actively writing down the value of their own business. This is the kind of data that professional traders on platforms like Interactive Brokers live for because it creates such violent dislocations. This recent action is the story. The stock has been unbelievably volatile. Just a few weeks ago, in late October, this stock was a penny stock, trading well below $1. Then, on news of an expanded partnership with Walmart and its inclusion in a meme stock ETF, the stock squeezed. It absolutely exploded, running over 140% in a single day, briefly touching $7.69 a share. This was a classic retail-driven short squeeze, amplified by Robinhood stock trading and social media hype. It had all the hallmarks of massive volume, a huge percent of the float short sold, and a news catalyst that sounded good. But it had zero connection to the fundamentals. While traders were piling in, the fundamental reality, which we now know from last night's report, was that the business was seeing its sales fall off a cliff. The squeeze was a phantom. The Walmart deal was real, but it was not nearly enough to offset the systemic decline in consumer demand that the company is experiencing. And this volatility is happening against the backdrop of what might be the single most important event for the stock this year: the massive, crippling dilution from its October debt exchange. To save itself, the company had to exchange its convertible notes. In the process, it issued over 316 million new shares of common stock. Think about that. It massively diluted every single existing shareholder. The lockup period for those new shares expired on October 16th, unleashing a potential torrent of new supply onto the market. So while the meme stock crowd was trying to squeeze the price up, hundreds of millions of new shares were becoming eligible to be sold, creating a brick wall of supply. This is the structural headwind that no amount of online investing hype can overcome. It's a company with a high cash burn rate, falling sales, and now a massively expanded share count. It's a terrible combination. This isn't like buying Tesla stock or Apple stock, which are backed by strong growth and massive profits. This is a speculative bet on survival. What does this mean for the average person's investment? It means that a self-investing individual looking at BYND on their Fidelity mobile app sees a stock at $1.31 and must understand that this price reflects a company in deep, deep trouble. The CEO, Ethan Brown, tried to paint a positive picture last night. He spoke of three important building blocks, focusing on the balance sheet: reduced leverage, extended debt maturity, and added liquidity. He is in essence saying, yes, the house is on fire, but we successfully refinanced the mortgage. He is admitting to category headwinds and a softer top line, which is corporate speak for people are buying less of our stuff. The market is listening to that, not the balance sheet spin. When a company with negative gross margins and falling revenue adds liquidity, it just means it has found a way to fund its losses for a little while longer. So what does Beyond Meat actually do? For those who missed the hype, the company's business was built on a simple, powerful idea: creating plant-based meat substitutes that look, cook, and taste like their animal-based counterparts. Its main products are the Beyond Burger, Beyond Sausage, and Beyond Beef, which are made from plant proteins, primarily from peas. The business model is twofold: sell through retail channels like supermarkets, its largest segment, and sell to food service partners, meaning restaurants, from small chains to quick service giants. At its peak, the company had landmark partnerships with chains like McDonald's, Yum Brands, KFC, Taco Bell, and Starbucks. The idea was to get its products everywhere, making the switch to plant-based seamless. The problem, as reports from the last 2 years have shown, is that the initial trial period for consumers seems to be over. The products are expensive, often costing significantly more than traditional meat. And in an inflationary environment where grocery bills are soaring, that price premium is a death sentence. Consumers are trading down, not trading up to a luxury plant-based alternative. And furthermore, the category itself has become saturated. Every major food conglomerate from Tyson to Kellogg launched its own competitor, and competitors like Impossible Foods are fighting for the same limited restaurant and grocery shelf space. Beyond Meat was the first mover, but it failed to build a lasting moat. The taste, texture, and price were never quite good enough to spark mass-market adoption beyond the initial wave of curious consumers and dedicated vegans. The company's own data, showing a 13.3% revenue decline and a 10.3% drop in volume sold, is the ultimate proof. This is the important news to understand. Beyond Meat isn't just one thing. It's not a tech stock. It's not an AI company. It's a food company, and understanding that is critical for any beginning investor. This brings us to the future outlook, and the tension between expectation and reality has never been starker. The lingering expectation for some investors is that this is a turnaround story, that online investment in BYND now will be a life-changing event in 5 years. They're hoping for a new product, a huge restaurant contract, or maybe even a buyout. They might be using investment help services or intelligent portfolio tools to see if this fits into an aggressive growth sleeve.